Hello, my name is Nisha Thakrar. Welcome to our first episode of Ned Talks, where we'll be discussing on a weekly basis our thoughts on recent market events, implications for asset class, and then, of course, what this all means for portfolio construction. In today's episode, we'll be talking about the recent Bank of England interest rate hike and what this means for bonds. Last week, we saw the 14th consecutive hike in the base rate, taking us all the way up to 5.25%. The last time we saw such levels was February 2008. But actually, if we look back into the history books, this is a level that's much closer to the long-term average. Of course, we can't talk about interest rates in isolation. UK inflation hit a high of 11.1% back in October 2022. Since then, we've been on a downward pattern of disinflation, taking us all the way to 7.9%. But that's still a stubbornly high number. And it's painful for any one of us who's done the food shop or who happen to have mortgages that are set to expire pretty soon. To go deeper into this topic, I'm delighted to be sitting here with David Roberts, a 30-year veteran bond investor who, according to LinkedIn, is not young enough to know everything. We'll be chatting about the persistence of UK inflation, what makes the UK an outlier, where next for rates, and crucially, where his conviction lies. David, looking at the MPC minutes, the UK inflation conundrum appears to be a much trickier problem relative to other service-orientated economies like the US, for example. It's double the level of the US, and we're looking at potentially a high of close to 6% at the peak. Why has UK inflation been stickier?
Hi, Nisha, and thanks everyone for dialing in. First, I should thank, I think it's Oscar Wilde for that LinkedIn quote. If it's not, I'm sure someone will correct me. I think your point on UK inflation relative to other parts of the G7 is very, very well made, and I think it's got huge implications for how we should be thinking about bonds, both in a domestic setting and then also in a global strategic setting. We do need to remember, I think, that the UK economy is very much an open economy, certainly compared with other parts of the G7. It's also an economy that tends to be services-led, and if we think about that, the most recent inflation data that I've seen for the UK goes back to June, when goods inflation was actually down to around 8% in the UK, but services, importantly, was holding tight at about 13.7%. Still way above MPC comfort levels. Partly to blame for that, in my opinion, is again this idea that the UK is an open economy, so we do import quite a lot of inflation. And it's important, I think, to note that on a trade-weighted basis, despite all those interest rate increases, sterling has actually fallen over the past 18 months. So that does have an implication for importing inflation. Importantly, also in that debate is really what type of inflation or which goods and services we are importing. Now, in many measures, about half of the food that we consume in the UK is imported. So when you think about that, we're importing a large proportion of the stuff which has seen perhaps the greatest degree of price appreciation. And you mentioned doing the weekly shop. So when you add that together with the fact that sterling has been a little bit weaker, that's quite a powerful combination that has created this slightly stickier CPI in our domestic economy compared with what is experienced across the rest of the G7, Nisha.
Thank you, David. I mean, thinking about the path ahead, the ECB, the Fed, and the Bank of England have decided to take a more data-led approach going forward. The challenge, of course, though, is determining what data, indicators, or survey is going to give you the most accurate picture of those transmission effects.
Yeah.
Now, I know this is something you have commented on in your past LinkedIn post, but I'm curious, if you were a member of the MPC today, what would you be looking out for?
Again, I think it's very important. Something they've commented on, and it's true not just of the MPC, but G7 banks, whether it's the ECB or the Fed. I really worry when I hear this phrase data dependent, that what it really means is they'll look at last month's or last quarter's data and then try and use that to predict the future. Whereas in reality, there are a number of lead indicators that I'd be much more comfortable with central banks paying attention to. Certainly, the Bank of England do spend quite a lot of time sending out their, gathering market intelligence through their local agents, and that feeds into their decision-making process too. It's not always hugely transparent for people like me in the market. So the type of things that I tend to focus on are PMI data. Again, it gives quite a good indication of what's likely to happen, what the demand is for goods and services over the course of the coming few months. And that, to an extent, relies upon what companies are seeing with respect to projected demand. So that's an important forward indicator. One other thing that I look at very carefully is the commodity complex and trying to understand what the commodity dynamic is, because as we've seen for the last few years, commodity price cycle does tend to lead inflation in the broader economy, and there's no surprise there. On that note, we should remember perhaps, or certainly focus a little bit on some of the commodities where at a broad index level, we've seen prices rise between 10 and 15% over the course of the last 1 to 2 months. So I think that there's a decent chance that filters through and creates a degree of stickiness in UK and indeed broader G7 inflation as we move through the course of the autumn. Then perhaps the last thing is trying to get a handle on credit creation, again, understanding whether people are borrowing to consume, or whether they're divesting, that they're taking money out of savings accounts and so forth. Where is the source of what we currently continue to see as a strong consumer? So rolling that together then, understanding what's happening in sterling, looking at PMIs, and then trying to understand commodity prices and indeed credit creation, I think are metrics that I would look at, Nisha.
So what I'm hearing from you is that there are a combination of different pieces of data that I think are helpful for you to understand the forward-looking view rather than the rear view itself. So, I guess thinking about where next, I mean, what's the investment case for UK government bonds?
Well, I think a lot to answer that question, you really have to put yourself into the shoes of the individual investor and understand their needs and also the time horizons that they're looking to invest for, Nisha. I look at the market and think that a couple of years ago we were lending to the UK government at a yield that was well below long-term inflation. So yields were close to zero. And forget about the spike in inflation that we've seen recently, but the MPCR are mandated to control inflation around about 2%. So fast forward to today and I look at that 4% annualized return that you can get just buying a basket of gilts. And that to me is quite an attractive point relative to where inflation is likely to be in the medium to longer term. So I'm really talking about the next 5 to 10 years. And if you think about that, if inflation does come down to about 2%, stays at that kind of level, then what we're going to see is a return on gilts well above inflation on an annualized basis. And really, again, we need to remember if we have a yield on gilts at 4 to 4.5%, then over the next decade, that's likely to produce a nominal return for investors of between 40 and 45%. That's well above current inflation expectations. So I think that there is undoubtedly a concern about UK public finances. Perhaps we're going through another political cycle. Who knows exactly how that's going to play out? The UK continues to run with a significant deficit, and it's undoubtedly true that we could see gilt yields deteriorate a little bit further from here. So, as I mentioned, this idea of investment horizon, what exactly is you want your bonds to do? But I think if you can be in a position to buy into a market where, for what I view as the value part of an investor's portfolio, if you can generate above inflation returns from the value part of your portfolio, I think that's a pretty good place to start, Nisha.
So what I'm hearing from you is quite a compelling case for government bonds, a high quality asset with quite an attractive potential return profile over the long term. Let's pivot to corporate bonds here because UK companies are facing growing pressure. We've got a weaker earnings outlook and quite frankly an anemic economic growth perspective as well. Where do you see the opportunity and what risks are you paying attention to in this particular part of the market?
Yeah, well, again, there's no escaping sterling in all these debates. So we know that a big proportion of UK listed companies derive their earnings or much of their earnings from the international market. So a weak sterling or sterling falling on a trade weighted basis does boost earnings. So that's great in some respects. It's good as a bond investor because if they borrowed in sterling, those international earnings do make it easier for them to service their debt. So less likelihood of downgrades or defaults. The flip side of that is perhaps a temporary boost to earnings might see a change to dividend policy. And as a bond investor, we really don't like companies paying out all their earnings in terms of dividend. That just stretches the balance sheet in the future. So there's a bit of a mixed message there. I would say, though, that if it depends very much if you're following a global strategy, if you have the flexibility to invest outside of the UK corporate bond market is quite a small part of the global bond universe. And one of the big advantages of a diversified global strategy is you can see geographic diversification. So I would say at the moment, you can probably toss a coin. It's a kind of 50-50 column whether UK corporate debt is really good value or not. It's certainly not compelling, but it doesn't look blindingly expensive as it did maybe a couple of years ago. So what I would say, if you're running that diversified global strategy, you can certainly choose to ignore UK corporate bonds, unlike perhaps the domestically focused investment grade or strategic funds. So I think it very much depends on your investable universe. The market doesn't look particularly cheap to me. There are some specific opportunities, but certainly when I look at the global market, then I can see a good reason to perhaps not be overly committed to the UK and take advantage of some of those opportunities in the more broad global market, Nisha.
So from a top-down perspective, perhaps not as attractive from a valuation stance, but
Yeah.
selective opportunities are there.
Yeah,
and of course, and of course, taking the broader lens of going global gives you that flexibility to look elsewhere. David, let me just summarize some of what we've talked about here today. UK inflation still problematic and creating uncertainty, even if we've seen a disinflation trend begin. The path to taming that, of course, could mean interest rates staying high for longer. And that could mean that we're closer to the long-term average in terms of what interest rates settle on in the near and medium term, rather than a collapse that's close to the 15 years we've experienced. And for bond investors, there's lots to be cheerful about. Unlike savings rate for instant access accounts, higher UK rates have translated into higher bond yields, and that's creating plenty of value across high quality assets like government bonds and corporate bonds. Well, we hope you've enjoyed this episode today. Thank you for joining us, and we hope you join us next time on Ned Talks. Have a great rest of the day.